How do you keep your portfolio on track in a volatile market when choosing the appropriate asset allocation is the only one component of successful investing? It necessitates avoiding errors that could severely impair the potential long-term growth of your portfolio. You can significantly increase your likelihood of achieving your financial objectives by merely being aware of and avoiding any one or more of the common mistakes that investors make. In this video, we'll talk about 10 mistakes that every investor makes. But before that, make sure to subscribe to the channel and hit the bell icon for more amazing content. Let's start with today's video without further delay. Number 10. Not having clear investment objectives. A common thought among investors who suffer substantial losses is, "I just need to get my portfolio back to where it was." Although this response is natural, it is overly restricted to current events. Before investing, an investor must have a clear understanding of his or her own objectives, which should be reassessed every year. You're considerably more prone to react impulsively to short-term market developments without clear objectives and goals. Before making a decision, do your own research on investing. This is a crucial step since it guarantees that you understand the investment's risks, including the possible losses or gains. You think about how it fits into your current portfolio, and you be aware of the costs and any early withdrawal penalties. Discover the features of various investment products, the dangers associated with them, and whether or not they are a good fit for you. Number 9. Not having an appropriate time horizon. Making the wrong investment choice for their planned time horizon is the biggest error made by investors of all ages. How long until they need the money? Customers commonly ask us where to make short-term investments. When interest rates are less than 1%, nobody wants to deposit money in the bank. The issue is that if you invested money in the stock market, you might have made 47% or lost 39% a year later. The S&P 500 index has had positive and negative returns each year since 1950 respectively. Naturally, the plus 47% seems amazing, but when investors see their account decrease by 39% in a single year, they get utterly dejected. Some individuals equate trading stocks with gambling because they believe the results are unpredictable. The gambling comparison only applies if your time horizon for investing is too short. Therefore, it's never a good idea to invest in short-term funds, anticipated to be needed in 1 to 3 years. Despite the poor interest rates, it should be in secure, liquid investments like an online savings account or a CD. An investor may frequently concentrate on short-term if they don't have a suitable time horizon. Depending on when you might need the money, for your children's education or retirement for example, you might have a medium-term or a long-term time frame. Changing an investment portfolio in response to momentary market swings is a recipe for failure. Number 8. Underestimating longevity. Running out of money in retirement is arguably the danger that investors must deal with the most unpleasantly. Although individuals strive their entire lives to prevent this, lifespans are just increasing. This necessitates that their money endures longer. Today, a man who is 60 years old and lives in a developed nation can expect to live to be 83. Avoid putting your lifestyle or investment goals at risk by making too many short-term plans when you assess your retirement portfolio. According to a survey by the Society of Actuaries (SOA), half of the customers grossly underestimate or grossly exaggerate their life expectancy by at least 5 years, depending on their health, income, lifestyle, and even family history. Overestimating it may result in failure to plan ahead for financial dependence, while underestimating it increases the chance of outliving retirement funds. Unsurprisingly, the survey finds that one of the key elements affecting longevity is health. People were more likely to underestimate their life expectancy by 5 or more years if they self-reported as being in less good health. But when it comes to predicting lifespan, health is not the only factor. Number 7. Ignoring the impact of inflation on your portfolio. Investors frequently ignore their purchasing power in favor of concentrating on the worth of their portfolios. Inflation can reduce the purchasing power of a portfolio. Many investors could require greater portfolio growth than initially expected due to the negative effects of inflation on purchasing power. It's crucial to account for the impact of inflation when calculating the return on your portfolio. A portfolio that increases at a rate of 5% annually has a real annual return of only 3%, even if inflation is as low as 2% annually on average. When planning for your financial future, it's simple to disregard inflation in the current economic climate. A 4% inflation rate might not seem significant at first, but think about how it will affect your money's long-term purchasing power. With annual inflation at 4%, a $1 would be worth just 44 cents in just 20 years. Given the same inflation rate and 20-year time frame, the cost of a $1,000 refrigerator will be more than double to $2,200. An automobile that costs $23,000 now would cost more than $50,000 under the same circumstances. Additionally, damaging to your investments is inflation. Not only the interest rate you receive, but also the real rate of return, which is calculated by accounting for the impacts of inflation, must be taken into account when calculating the return on investment. Your real rate of return can be determined with the assistance of your financial advisor. Clearly, you must build an investment portfolio that will deliver adequate returns for accounting for the rate of inflation if you intend to attain long-term financial goals such as college savings for your children or your own retirement. Number 6. Tiring of a long-term investing strategy. An investor may be tempted to give up their long-term investment strategy after a protracted period of market volatility, especially if the money has decreased and then rebounded, but it's not increasing very quickly. Such emotional choices might be detrimental since they divert attention from realizing your investment objectives. Investors must pay particular attention to maintaining their long-term strategy and objectives during periods of market turbulence. Number 5. Reacting after suffering losses. Investors may be tempted to sell equities after a sharp decline in the stock market once they have recovered their losses. Smart investors are aware that the bond and stock markets can be unpredictable. Equity markets have a history of advancing and reaching new highs after emerging from a bear market. It's simple to believe that the market will never rebound while it is experiencing a bear market. Frequently, the market starts to improve just as the typical investor starts to sell off his holdings. The best piece of advice is to constantly keep going. Assume that you might experience financial losses at some point if you're involved in a risky business or a venture. Emergency fund. An emergency fund is a must for any household, but it becomes even more important if you work for yourself or make risky investments. You should have enough money set up for emergencies to last you at least 6 months. Number 4. Improperly judging risk. Building a successful portfolio requires a thorough understanding of your risk tolerance and what risk means in the context of investing. When considering an investment, it's critical to look at the risk involved and calculate the potential loss of capital. While taking on too much risk can result in greater losses than you're willing to tolerate, taking on too little risk can result in underperformance and failure to fulfill long-term financial goals. Many investors make poor risk judgments. Generally speaking, depending on your cash flow requirements and return objectives, the longer the time horizon of your investments, the more risk that may be reasonable. Over the long term, increasing risk can lead to higher profits. However, portfolios that are too cautious may perform poorly. Number 3. Avoiding diversification. Although most investors are aware that it is wise to diversify, most continue to invest in their local or preferred market. As America makes up approximately half of the developed equities market worldwide and less than 25% of the world's GDP, a portfolio consisting solely of US stocks will miss the rest of the global stock market. Professional investors might be able to get alpha or excess return over a benchmark by holding a small number of concentrated positions, but average investors should not do that. It's better to adhere to the diversity idea. A portfolio of exchange-traded funds or ETFs or mutual funds should provide exposure to all key industries. Include all significant industries while creating a personal stock portfolio. Don't devote more than 5 to 10% of your overall portfolio to any one investment, as a general guideline. Therefore, diversify your portfolio and avoid the mistake of concentrating primarily on one market. Number 2. Making investments based on the media. Publicly available news is effectively priced into the capital markets and reflected in share prices. Reacting in line with media trends leads to overreacting, bad timing, and trend following. Investors must possess unique knowledge or have a unique perspective in order to outperform the market. Although challenging, obtaining this knowledge is not impossible. It requires time, effort, investigation, and excellent analytical abilities. Many investors decide to utilize the assistance of an investment advisor to time the market and manage their investment portfolio because they lack the time or the expertise to do so. Number 1. Asset allocation. Numerous studies have shown that an unsuitable asset allocation can have a significantly greater effect on your success than the stocks that you select or market timing. It's crucial to balance your portfolio to meet your financial needs and risk tolerance, especially when the markets are erratic. Bonds provide some security when equities are underperforming and supply additional income to the portfolio, even though equities may beat them over the long term. The road to wealth building is more complicated than just buying advantageous stocks. You must adhere to the correct asset allocation in order to create a successful investment portfolio. In light of this, give balancing your asset allocation the top priority the next time you get the chance to invest in stocks. Don't forget to diversify. To lessen the losses sustained during market collapses, diversify your stock holdings while allocating your investment portfolio among several asset classes. That's it, guys. These were the 10 mistakes that every investor makes. If you liked this video, make sure to subscribe to the channel and hit the bell icon. Leave a like, share it with your friends and families, and jot down your thoughts in the comment section below.